Welcome back to the deep dive.
Your direct line. Yeah.
Exactly, your direct line to making sense of these often complex corporate earnings calls. We try to pull out the really vital stuff for you.
Cut through the noise.
Precisely. And today we're digging into Cleveland-Cliffs Q2 2025 call.
Yeah, quite an interesting one.
It really is. The big question, I think, is can an old school integrated steelmaker like Cliffs actually forge a new path?
Right, not just by tweaking operations, but maybe by using these shifts in global trade and finding value in unexpected places.
Yeah, that's what we're going to unpack, how they're trying to do it. Now, quick reminder for everyone listening.
Yes, the standard bit.
Companies make forward-looking statements. Always important to remember those are subject to risks, uncertainties. You can find the details in their public filings.
Absolutely. Standard procedure.
But with that said, the overall feeling from the call, it seemed pretty positive, but balanced.
Agreed. Definitely highlighted improvements and a clear optimism about the second half of the year.
So let's get into it. Let's unpack the results first. What did the Q2 numbers actually look like?
Okay, so looking at the core figures, Cliffs showed a really substantial turnaround. Their adjusted EBITDA.
Right, the earnings before interest, taxes, depreciation, amortization. Key metric.
Exactly. That saw a huge jump, $271 million improvement from just the previous quarter.
Wow, $271 million. That's significant.
It really is. And it wasn't, smoke and mirrors. It came from hitting higher shipment volume targets, which then boosted their operational efficiency and, importantly, brought down production costs.
Okay, so higher volumes leading to better efficiency and lower costs. That sounds like a good formula. Can you break down the specifics, like volume numbers, costs? What stood out?
Sure. Volumes reached 4.3 million tons.
4.3 million.
Which was a solid 150,000 ton increase over Q1. But here's the kicker, and honestly, it kind of defied expectations.
Yeah.
Their unit costs decreased by $15 per ton.
Decreased? I thought the expectation was for a slight increase.
That's right. Most analysts were bracing for cost to tick up a bit. So a $15 drop really signals some strong operating performance.
Okay, wow.
And on top of that, the average selling price, it climbed too, $1,015 per ton.
Up from Q1.
Yep, a $35 per ton increase from Q1, mostly driven by higher index pricing. So you had more volume, lower costs, and better prices all hitting at once.
That does sound like almost a perfect storm in a good way.
Pretty much, yeah.
So the income side looks strong. What about their cash flow, the balance sheet? Is this translating into, stronger financial health?
It is, mostly. There's a small nuance in Q2. They actually had a cash outflow of $67 million.
Oh, okay. Outflow.
Yeah, and this is important. Management explained this was due to a pretty meaningful release in working capital.
Meaning they freed up cash tied up elsewhere.
Exactly. Specifically, they made some dramatic cuts to inventory levels, things like iron ore, coke, basically turning stockpiles back into cash. It's a strategic move.
Got it. So managing inventory to boost cash.
Right. And despite that outflow for the quarter, they still ended with really robust liquidity. $2.7 billion.
$2.7 billion. That's a solid cushion.
Definitely. And net debt, it's manageable, and they fully expect it to start trending downwards soon, which, fits their pattern after big acquisitions. Pay down that debt.
Okay, so disciplined financial management, strategic inventory moves, that leads nicely into their broader strategy. Operationally, financially, how are they actually getting these cost improvements? Where's the focus?
A lot of it comes down to their footprint optimization. Those initiatives are really starting to take hold.
Right.
And we should see more impact in the second half of 2025.
Yeah.
Management seems laser focused on two things: cutting costs and selling steel.
And the Stelco acquisition, that played a role. That was late 2024.
Huge role.
Yeah.
Acquiring Stelco was a major driver for hitting cost synergy targets.
Yeah.
A big part of it was being able to use excess coke produced at Stelco's Hamilton facility in their own U.S. mills instead of buying it from outside.
Right. Internal supply versus external. How much difference does that actually make? Is coke a big cost component?
Oh, it's immense. Management put a number on it. They've got 2 third-party coke contracts that either just expired or will end soon.
Okay.
Making their own coke versus buying it externally. They said the benefit is north of $100 per ton.
North of $100 a ton.
Yeah. That is a massive cost advantage over competitors who have to buy coke.
Wow. Okay.
And there are more tailwinds potentially coming from lower coal prices expected in 2026. Plus, They also proactively trimmed their full-year SG&A spending and capital expenditure budgets.
SG&A is selling, general, and admin costs.
Correct. Trimmed those, along with CapEx, by a combined $50 million.
Yeah.
Just tightening the belt where needed as they optimize their footprint.
So that north of $100 per ton benefit is huge. Their overall cost reduction target for the year, the $50 per ton one, sounds like they're pretty serious about hitting it.
They seem very confident that $50 per ton reduction for 2025 compared to 2024, they say it's firmly on track.
And they expect more reductions.
Yep. They're guiding for another $20 per ton cut in Q3 compared to Q2, and then more again in Q4.
Okay.
And it's not just talk. They confirmed their Cleveland 6 facility is now fully operational.
Replacing the idled Dearborn plant.
Exactly. Part of that footprint optimization plan in action. Real physical changes, driving efficiency.
Impressive discipline. Okay, let's shift to capital allocation. You mentioned paying down debt. How are they planning to speed that up?
Priority one for any excess free cash flow is debt reduction, period. Get leverage down to their targets.
Consistent with their history post-acquisition.
Absolutely. But what's really interesting, and maybe less talked about, is they're actively exploring selling off some non-core assets.
Non-core assets?
Yeah, they brought in JP Morgan to help. They think this could potentially generate billions of dollars in cash if they find the right deals that unlock value.
Billions with a B. That's a lot of cash.
Yeah.
Any idea what kind of assets?
Well, besides potentially some operating assets that aren't central to their main steel business, they highlighted something quite unexpected. Significant inbound interest in some of their recently idled facilities. Places like Riverdale, Steelton, Gahaken.
The old plants they shut down. Who wants those?
Get this. Data center developers.
Data centers in old steel mills.
Apparently. Their locations, plus the existing heavy-duty infrastructure for power and water access, makes them surprisingly attractive for data centers.
That's incredible. Talk about creative reuse.
Right. And any cash from selling those would go straight to paying down debt. Another path to deleveraging faster.
Finding gold in unexpected places, indeed. Are there other sort of niche areas where they're innovating or showing strength? I heard their stainless steel business described as a best-kept secret.
It kind of is, yeah. It's maybe a smaller part of the whole picture, but it's consistently profitable.
Okay.
And they just finished a big investment there. $150 million in a new bright anneal line at their plant in Coshocton, Ohio.
Bright anneal, what's that for?
It targets really high-end stuff. Think of shiny automotive trim around windows, or the inner drums of washing machines and dryers, critical appliance parts.
So higher value specialized products, not just basic steel.
Exactly. They expect a quick return on that investment. It shows they're not just about volume, but also smart, targeted investments in higher margin areas.
Makes sense. Okay, let's widen the lens a bit. Macro factors, industry drivers, Section 232 tariffs are always a hot topic in steel. What's Cliff's take on their impact right now?
Management sees them as very supportive. The 25% tariff from last year, and especially the recent hike to 50% on June 4th,
Right.
They argue it's crucial protection against what they call unfair foreign competition. Citing lower wages, subsidies, weaker environmental rules abroad.
And they think the current administration will keep them in place, not use them as like bargaining chips.
They see no indication of that happening. They seem to view the current administration's stance as quite favorable and expect it to hold.
Okay. And are they actually seeing results? Is it making a difference in the market?
They point to the import data, yeah. Both flat-rolled steel imports and light vehicle imports hit multi-year lows back in April.
Interesting. Vehicles too.
Yeah, they see that connection. They believe the administration's focus on both steel and automotive is vital for the economy, for supply chains, national security, and they position Cliffs right at that intersection.
Which brings us neatly to the auto sector itself. Huge market for steel. What are they saying about the current situation, the constraints, the potential for a comeback?
Well, their primary concern seems to be consumer financing for vehicles.
Making it easier for people to buy cars.
Exactly. And they were pretty blunt about it. They think the Federal Reserve's interest rates are unnecessarily high.
Wow, directly calling out the Fed?
Yep. They argued there's no sign of tariffs causing inflation, so rates are just too high, hindering car sales. They basically said they expect a big auto sector takeoff once rates drop by, say, 50 to 75 basis points.
0.5 to 0.75%.
Right. And in their words, a new Fed chairman is appointed.
That is remarkably direct. What does that tell you? Frustration, confidence. And how ready is Cliffs if that auto resurgence actually happens?
I think it shows real conviction. that the underlying demand is there, just being held back. And yes, they stressed they have significant underutilized auto capacity right now.
So they can ramp up quickly.
Very quickly, they claim. They also see OEMs, the car makers, already starting to bring production back to the U.S.
Reshoring.
Yeah, and shifting away from using Asian steel in their Mexican plants, opting for U.S. steel instead. They painted this as a major win for the current administration's policies.
And they feel they have an edge over competitors in serving that resurgent auto market.
Definitely. They highlighted that some competitors might not get their labs approved for auto supply as quickly. And they pointed out a big ArcelorMittal slab supply agreement expires in December 2025.
Opening a potential window for Cliffs.
Exactly. A window of opportunity.
Powerful positioning.
Okay, beyond Section 232 on steel generally, any other trade policy ripples affecting them or their rival?
Oh, yeah. The new 50% tariff on Brazilian pig iron. That kicks in August 1st?
Pig iron affects Cliffs. Not directly, no. They don't rely on imported pig iron. They make their own substitute, hot briquetted iron or HBI, in Toledo. Plus, they're vertically integrated using American iron ore, coal, natural gas.
Got it. So who does it affect?
Primarily some of their EAF competitors. Electric arc furnaces often use scrap, but blend in pig iron for quality. So this tariff hits their input costs.
EAF versus integrated like Cliffs.
Right. And Cliffs management is strongly against any exemptions to that tariff, arguing it creates unfair cost advantages for others.
Interesting. What about other markets? Canada.
They flagged Canada as a major issue for imported steel, said Canada's also a net importer and is being, quote, taken advantage of by foreign dumping.
Dumping steel.
Yeah. Even though Cliffs keeps its Canadian production from Stelco in Canada, they feel the Canadian government isn't doing enough to stop unfair trade, especially from countries with free trade agreements using Canada as an outlet.
So they want Canada to adopt stronger protections, like the U.S.
That was the strong message from the CEO, yeah.
Right.
Needs to happen to foster a strong domestic industry there, too.
Strong words on trade. Okay, final macro point. The competitive landscape overall and foreign investment. U.S. steel being acquired by Nippon Steel must be changing things.
For sure. The U.S. is still the place to be for steel, clearly. And that Nippon deal, nearly $29 billion.
Huge number.
Management sees it as validation of the integrated model mining, pelletizing, blast furnace, the whole chain, especially since most U.S. production, over 70%, is EAF, scrap-based.
So Nippon's move reinforces the value of Cliffs' integrated structure.
That's their take. And Nippon being active here creates, new dynamics, new optionality for everyone else. They even hinted that foreign investment in Cliffs itself could now be attractive to others.
Really? Selling parts of Cliffs?
They signal openness, given their position in automotive, electrical steels, maybe carve-outs, asset sales. Seems like various strategic options might be on the table.
Very interesting. Okay, so bringing it all together, what's the investor outlook? How does Cliffs see the rest of 2025 playing out?
They sounded quite confident. They believe the macro trends are really aligning in their favor now. The second half of 2025, they said, is shaping up to be much better than the first half.
Continued improvement from Q2.
That's the expectation. Continued adjusted EBITDA improvement from Q2 into Q3, with shipment levels staying strong around that 4.3 million ton mark.
And the cash flow.
They highlighted their track record averaging over $1 billion a year in free cash flow since their big transformation. They expect that to accelerate the debt paydown.
And that $50 per ton cost reduction target for the year, still sticking to it.
Absolutely. In fact, they called it conservative.
Conservative, meaning they think they can beat it.
That's the implication, pointing to things like scrap prices, the pig iron tariff impact on competitors, their internal coke advantage, better mill efficiency, lots of factors they think could help them do even better than $50.
So focus remains on discipline, cash flow.
Operational discipline, capital prudence, free cash flow generation. That's the mantra.
Got it. One quick thing before our trade idea, the Middletown project. That big, ambitious plan. Any updates?
Yeah, it's being revamped quite significantly. The original idea, using hydrogen with EAFs.
Right. The green steel angle.
That's not moving forward as planned. Main reason, lack of available hydrogen infrastructure. Just not there yet.
So what are they doing instead?
They're working with the Department of Energy now to preserve and enhance Middletown using traditional American resources. Coal, coke, natural gas, Minnesota iron ore.
Okay.
But here's the twist. They're aiming to make the blast furnace operate fully under an AI-driven system.
AI controlling a blast furnace. Seriously.
Apparently so. A very futuristic turn for a very traditional process.
Wow, okay, that's unexpected. All right, let's pivot to our not financial advice segment. Time for an outrageous but plausible trade idea based on this Cliff's deep dive.
Okay, let's try this. Given everything we've heard about Cliff's unique position, its integration, the trade environment, how about a long position in Cleveland Cliffs, ticker CLF?
Long CLF, okay.
Paired with a short position against a, let's say, less integrated, domestically focused EAF steel producer, a competitor that relies more on scrap and maybe imported inputs.
Okay, a pairs trade. Long Cliffs, short an EAF competitor. Break down the logic for the long CLF side first. Why buy Cliffs?
Several strong reasons stack up, I think. First, the whole automotive reshoring angle. Cliffs is positioning itself as potentially the only domestic player with the immediate capacity and the crucial OEM approvals ready for a surge in U.S. auto production.
So market share gains in a growing domestic market.
Right. Second, that vertical integration advantage is huge. Being independent from imported stuff like pig iron, especially with that new 50% Brazilian tariff, that's a massive cost shield compared to EAFs who need imports. And remember that north of $100 per ton internal coke benefit.
Big cost difference, okay.
Third, the asset value unlock potential. Selling non-core assets, maybe even those idled plants for data centers that could bring in serious cash, speed up debt reduction, really improve the balance sheet quickly.
Unexpected upside.
And fourth, just the continued protection from Section 232 tariffs, creating a more favorable home market for them.
Okay, compelling case for long CLF. Now, why short the hypothetical EAF peer? What's the vulnerability there?
Well, a pure play EAF mini mill, one without Cliffs integration. They could face rising input costs, right? Pig iron tariffs being a prime example.
Squeezing their margins.
Potentially. Yeah. And they might be at a disadvantage trying to capture that growing automotive business without Cliffs' established relationships, approvals, and maybe even the specific steel grades needed.
So squeezed on costs, potentially missing out on auto growth.
That's the thesis. So the trade isn't just basic fundamentals. It's really a bet on this convergence of factors. Protectionist trade policy working, U.S. auto manufacturing really coming back on shore, and Cliffs' specific strategy navigating all that. The outrageous part is betting against established global supply chains shifting so rapidly and betting on this policy-driven push for domestic integrated production models.
That is definitely provocative. A bet on a pretty significant industrial shift centered around Cliffs.
Okay, so let's wrap this up. We've really dug into Cleveland Cliffs Q2. Strong performance, clear improvements.
Definitely. Driven by getting leaner, smarter acquisitions like Stelco paying off, tight cost control, and that focus on debt reduction.
And they seem incredibly well positioned, or at least they believe they are, for these big macro trends. Trade protection, U.S. manufacturing resurgence, especially in auto and appliances.
Yeah, their moves optimizing the footprint, those creative asset sale ideas, the firm's stance on trade, even putting AI into blast furnaces, it points to a management team really focused on navigating this changing world.
Absolutely. Which leaves us with a final thought for you, the listener. As these global trade winds keep shifting and we see this renewed focus on domestic production, what is the future balance between integrated steelmakers like Cliffs and the EAF producers? Who really shapes America's industrial backbone going forward?
It's the central question, isn't it? Something we'll definitely keep watching. Indeed. And just one last time, remember this deep dive, it's for informational purposes only.
Definitely not financial advice.
Always do your own research before making any investment decisions.